My kids are never going to be able to buy right in Brisbane. They might have to move. Houses are going up so much. Brisbane's gone up in value 15% last year. Still better than not buying at all.
Once you're 18, you can legally buy a property in your name, right? What do they need to do to get the loan approved?
You would do the loan jointly with the parents and the kid at the same time. 90% owned by the kids, so they mainly own it, and the parents come in and they're a joint borrower. Their income is used to help prove it all.
What's the most surprising client story you have seen?
5% deposit, she had 15 grand and she's just made $500,000 in 5 years. It's crazy.
And what actually kills your credit score?
Lots of credit applications is the one that I noticed. That shows on their credit report. Obviously not paying your credit on time is a big one.
So what is the highest score you have personally seen?
1180. So the more debts you have in a way, the more debts you have that you pay on time, the better your credit score is.
If you could give only one piece of advice to your own kids, what would it be?
Think dentist? Think Dentaglow.
Hi, welcome to Aman Poonia Podcast. I'm your host, Aman. In today's world, there are 4 asset classes people invest in: property, share, businesses, and alternate assets. Out of these 4, everybody invests in property because everybody needs a roof over their head and everybody wants to be healthy, and property is a good way to get that done. Today, I'm sitting down with a seasoned professional in the finance industry. His name is Mitch, and he's been in the financial industry for more than 20 years and acting as a financial broker. So whether you are a first-time home buyer or a seasoned investor, this podcast is for you. We're covering the property investment journey from A to Z, and we'll be talking about all the different segments within that area. So sit back, relax, and bring a notebook and a pen and write some notes. And while you're doing so, don't forget to like, share, and subscribe so that we can keep on bringing these exciting and valuable guests to you so you can learn from them. Thank you. Enjoy the conversation. So coming to you, Mitch, welcome to the podcast.
Thank you, man. Happy to be here. I'm excited for it. Let's go.
Well, I've been talking to you for a while, and I found you very interesting because you give honest advice, practical advice, a lot of examples, and you go through in detail in each scenario and each discussion. So I thought, why don't I bring you to podcast and we have a casual conversation and discussion about it, so the people can learn about all those points, and hopefully if it can help even a single person, I think it would be a great advantage.
Yeah, awesome.
So my very first question to you, Mitch, is why anyone should use a finance broker rather than going to the bank directly?
Like a finance broker should be able to plan out your future, I think, whereas the bank's going to just maybe sell you one product or sign you up for one loan, whereas a finance broker, you can be honest with them, tell them everything, and they're going to help you through the process no matter what your circumstance is. There's plenty of good, guys in banks doing loans, but when you deal with a finance broker, they can really solve any solution, I feel like. And if there's no instant answer, put a plan in place for the future to help you achieve it.
But I see, and I'm guilty of this myself, Mitch, when you're dealing with a bank, you already have an established relationship. You go to the branch, you have the bank cards, you have their debit cards, you have their credit cards. So there's already an established relationship there. And then you feel at ease, right? I understand where you're coming from, that, the finance brokers provide more options. But looking from a client's perspective, like what's in their best interest, like how does it differ, because
Yeah.
you know what I'm saying?
Yeah, I mean, you've got an independent third party helping you. Like if you come to me and you want to go to a certain bank and you tell me, hey, that's my bank, all my banking's there, I'm going to make sure that I get you the best deal in that bank. And I'm going to compare that bank to a few others just to make sure that you're getting the best deal, if that makes sense. And I can manage the process for you. So,
Okay, basically taking the emotion out of it and
Yeah.
finding the best deal, because it's not about emotion, it's not about loyalty, it's about finding the
like it's the
Right
it's
deal.
the best product and the best solution for you as a client. I'm not going to fight you if you say to me, hey, I want to deal with A and Z. I'm not going to fight you and say I want CBA.
Yeah.
It's about what's better for you.
Fair enough. And what are the biggest misconceptions people have about finance brokers?
Some people, I think think it's a better process to go to their bank, like you were talking about. They think it's quicker and easier to go to their bank, but it's really not always the case. So, um, like the misconception with a finance broker, like I feel like I've had a lot of clients come to me where they've dealt with like 2 or 3 other brokers and they've got nowhere, and they come to me and they say, Mitch, like I'm trying to buy my first home, but I've been told that I can't do this. And I guess people might lack trust in brokers sometimes because they've been told they can't do things. So there are a lot of brokers, I guess, that might not have the experience, or they might specialize in a certain type of client or product, so they can't help everyone.
And I think it's also comes down to what profile a person has and what are their specific requirement.
Hmm.
Because sometimes some banks, they have particular lending policy and it might not suit a particular buyer. And I think with the broker, because they deal with multiple
And like we're going
banks.
to do the pre-checks. Like for example, I had a client yesterday that I dealt with. They wanted to get the best deal, but they wanted to go to Macquarie Bank because that's where their banking is. Their day-to-day banking's there, but their home loan was at a other bank. But they were going to apply directly. So I said to them, well, like we just need to collect your info, validate everything to make sure that you're going to be approved. Because so you don't know as a client if you're going to be approved or not. You're going to go to the bank, you're going to apply, and you think you can get approved, but you don't really know. So as the broker, we're going to check your credit report, check your borrowing power, check your income, and little certain things might not fit within that bank's policy. So with these clients, for example, they had quite a lot of debts. Their credit score wasn't actually that great. So I don't know if Macquarie is going to be the best for them. Maybe another bank might be better. Still a good deal, still a good rate, but don't want to waste their time applying somewhere where they get declined. Yeah.
Like I want to talk about the credit score and anything down the line, but it obviously affects their credit, score as well if they have multiple applications, which keep on coming
Some
on the
banks are
file.
really strict with it.
So
Yeah.
this could be a negative impact as well.
Yeah.
But anyway, another question to you, mate, is what do you wish every property buyer understand before they come to you, to seek help from you? What thing do you think they are prepared and they've already understood?
I think like through the loan process, people have just got to sort of understand that they've got to provide a lot of documents a lot of the time. I think for me as the broker, I feel like the client's here, the broker's here, the bank's here. You need to tell me everything. You don't need to hide anything from me. You need to be completely honest. Give me all the documents I need because then I can take you to the right bank to get you approved. So some clients, I feel like they're not quite truthful with the broker. But we'll uncover it. Then I have another conversation, ask the question. I go, oh, I forgot to tell you about that. Well, just be honest with your broker and be prepared to give everything up front. That's the quickest and easiest way.
So we need to add broker to the list, be truthful to your accountant, to your lawyer, and to your doctor. Now the broker needs to be there as well.
It's 100% true. It's 100% true. And then we'll take the right truth away to get your loan approved for you. So yeah.
No, fair enough. All right, let's talk about the first home buyers because that's where a lot of people, want to learn more because it's their start of their journey. They want to buy their first home. It's a very emotional decision.
hmm
So, how much deposit does a first home buyer really need in today's term in 2025?
It just really depends on their structure. But there's a few different things I could say. You could buy with zero deposit. So if you've got family members that want to be a guarantor, you could have zero deposit. So we've helped a lot of people with no money whatsoever, got good jobs but haven't been able to save. So you could buy with a guarantor with zero deposit if you really wanted to.
So, what happens in that case? Does the family or the guarantor they deposit the money?
No, it's used against their property. So say the guarantor, they own their own home and they've got some equity in it. What they do is they put their property up as security for the loan as well as the new property that's being purchased.
Okay, so they're using their home as a collateral for the deposit amount for the new purchase.
Correct.
But what if they already have a mortgage on their property, but they have equity in that? Can they still
That's
do it?
fine, yeah. So depending on the bank, generally up to 80% of the property value can be used for the guarantee. So for example, their property's worth $1 million, they only owe $500,000. There's $300,000 worth of equity that they've got there that they could use as a guarantee for the kids.
And the second bank will have the second mortgage on the property.
Yeah, so we could go to, again, like getting to the point of what's right for the client. Sometimes I'll tell the kids, we've got to go to your parents' bank because they've got all their banking there. They want to help you. It's easier for your parents. We don't want to refinance them. Sometimes the parents will move their loan as well to the bank for the guarantee because not all banks do guarantees. So if the parents are at the wrong bank, we need to move them to the right bank. And then sometimes it will be second mortgage. So the parents will stay at their bank, kids will go to a new bank, and that new bank will put a second mortgage behind the parents, and the parents would stay at their current bank. So it just depends what makes sense.
Fair enough.
for the client.
So while we're talking about this, let me paint a scenario to you. Imagine, let's say I have, say, two sons, one is turning 19 next year,
Mhm.
right? So he's about to, I guess, enroll in uni. Or halfway through uni, he's about to finish.
Mhm.
And I think once you're 18, you can legally buy a property in your name, right?
Correct, yeah.
But you're not working full time. You have a part-time job. If person A,
Mhm.
let's call him young adult or teenager, let's say that person wants to get into the property market early on,
Mhm.
what do they need to do to get the loan approved? What are the steps
So you're
they
saying
need
like
to
if
take?
they can't afford it on their own, like
Yeah,
they're
let's
working part-time,
like
they
they're
earn
working
30 grand a
part-time.
year, they can't afford a loan.
Yeah, they can't
Yep.
afford a loan.
Mhm.
Or what A, they should be doing. B, what are the alternate routes they can take? Like, borrowing against as a collateral, against a parent's property. That's one way.
Mhm.
But what are the steps,
For an instant,
they would
like,
be able to take?
for an instant solution. So let's say you've got a kid who's 18, wants to buy a home and they earn 30 grand a year.
Yeah.
Parents are willing to support. Kid's got no deposit and they're just starting. What would happen is you would do the loan jointly with the parents and the kid at the same time. And you might put the property 90% owned by the kid, so they mainly own it. They might get some of the first home buyer benefits, and the parents come in and they're a joint borrower. Their income is used to help prove it all. So mum, dad, son,
Yeah.
they can all own the property together and they can all afford it.
But do you still get the benefits of stamp duty exemption and all those things, or no?
Not all of it, no. So sometimes it's like a portion to the property. So if they buy 90% of it, maybe they get 90% of the stamp duty waivers and things like that. So, but that's another consideration. Like, is it more important to buy a property now and not get any benefit, but get in the market now when you're 18, or do you wait 2-3 years till your income's enough to get the benefits? Then properties cost more. You'd have to work out what's
Fair
makes
enough.
sense. Yeah.
What are the alternate options? Let's say if you don't have parents who want to support you in that case, what other ways can you go about it?
You would have to plan your employment, I guess. I mean, like if you're not earning enough, you would need to look to upgrade your job.
No, but that, I mean, let's say, someone is doing a part-time, business on the side, or they might be doing, some weekend market work they're getting some money in cash, or
maybe
they
with
have a summer
friends.
coming
Like I've
up.
had some clients buy with friends, so you might have like 3 friends that come together to buy their first home, and they'll get all the benefits, and then 3 incomes will support the loan. Like the main things when looking at the finance is, do they have enough deposit, which would be say 5% or 2% depending on the loan,
Yeah.
and can they afford it? So if you and I can't afford it together, but we're close, we get a friend, all 3 of us can afford it, and we all go in together and we own a third each, and
Like,
we're in the property market, and then 5 years time, revalue the house, go our separate ways, we've got money out.
interesting. Alrighty. Another question, is it better to have 20% deposit, or is it better to go with LMI? Like, what are your personal thoughts?
Depends what you mean by better. If you want a better interest rate and things like that and lower cost, then it's better to have a 20% deposit. But to get a 20% deposit is going to take a long
Let me
time.
rephrase, if a person has to save 20% to get better rate, is it that's a better route to take, or they can have easy earlier access to the
I think
property
definitely
using
buy,
LMI?
yeah. But definitely buy sooner with LMI. But there are banks now that do 90% no LMI, just for anyone. So there's a few banks that do 90% loan, no LMI. You pay a little bit of a higher interest rate, but don't pay LMI. So we're putting clients into those loans, and then the plan is after 12 months, they get a bit of equity, we refinance them out. So that's a way to put a small deposit but avoid LMI. But still, paying LMI is worth it. Like houses are going up so much. Like I think Brisbane's gone up in value, I don't know, 15% last year. Paying LMI of 10, 20, 30, 40,000, still better than not buying at all. That's my opinion.
Fair enough. And what is the biggest mistake you see first home buyers making when they're getting a loan?
I think the biggest mistake is shopping around too much. I think a lot of younger people now, they're online, they're checking all the ins and outs of all the different options. And there's a lot of like online lenders that offer really low rates, but they're also very conservative. So I think a lot of younger people are sort of going to those comparison websites trying to apply for something that they might not necessarily qualify for. So sort of like your question around the mortgage insurance. Is it about the cheapest rate, or is it about paying a little bit more on the rate to actually get the loan, get approved, and get into the property? So you just got to trust that your mortgage broker is going to give you the best option for you, but don't be focused on the rate. Like We're doing loans at the moment for people at say 5.3, 5.4%. I think online maybe you can get 5.1, but you're not going to get approved. It's going to take forever. They only help certain people. You could be wasting your time going for the cheapest rate and trying to like DIY your home loan without getting advice.
So basically, what I'm hearing is that people go to, say, online websites or online vendors,
Mm.
and they're getting might be a little slightly better interest rate,
Mm.
but they're not getting the full comparison, which product is best suited to them. And then they actually not getting the loan approved, and they might be missing out on a deal. And it's better to go and meet a physical person or
Yeah, like
broker and then
correct. And then they
get
think,
a
oh, I don't
variety of.
qualify. I don't qualify for that online rate. I've been declined. I can't buy a house. They give up and they stop for a year, and then they start again. So it's getting the right advisor.
So that's the biggest mistake you think
I
people are
think
making?
I think so. Yeah.
Okay, interesting. And how does a broker assess a person, like, if the client is loan ready, so to speak?
Our process is that I will collect your info, and then I'll check your credit report, and I'll do borrowing assessments to see where you're placed. So we look at your whole position. Nothing shows on your credit file. No applications going to a lender. We'll get all your info, have a look at it, come back to you with the best options for you, and fully assess it. Yeah.
Okay, for people who don't know what a credit score is,
Mm.
do you want to tell them what a credit score is?
Yeah, sure. So everybody's got a credit score. It's managed by Equifax. They're the main credit reporting agency in Australia. All of your credit applications that you apply for, personal loans, home loans, credit cards, all of the history is on there. It goes back about 2 years now for conduct on account. So say you've got a credit card, I will see for the last 2 years how you've paid it. Have you paid it on time? Have you been late? How you've handled that account? Have you had hardship and gone to your bank to ask for 3 months of no payments, those sort of things. And everybody's given a score between, 0 and 1200, but I have seen some minus, like if you've got really bad credit score,
minus as
minus
well?
200, I think is the worst one I've seen where you haven't paid anything on time.
That's interesting.
But some banks then are like hard line. If your credit score is not 800 or more, instant decline. If you haven't paid your accounts for the last 6 months in order, instant decline. Some will go back now as far as 2 years and go anywhere in the last 2 years, you miss one payment, decline. So, yeah,
So what is the highest score you have personally seen?
like a 1180, some close to
1180. Wow,
yeah.
that's pretty high.
So the more debts you have, in a way, the more debts you have that you pay on time, the
Mm.
better your credit score is, because you can prove that you can manage things. So if you've got 3 investment properties, 2 credit cards, and a car loan, and you're paying everything on time,
Yeah.
it's great, because the level of debt doesn't matter, but you prove that you can manage your debt.
But can I ask you a question? Like, I'm not 100% sure about this. My understanding is, and I'm pretty sure I would be wrong, that any debt which is in your personal name, that comes on your credit score file,
Mhm.
not the debt which you have taken in your business name or under in your trust. That doesn't come in your personal file.
Most
that-
most of the time, yeah,
that
that's
correct?
right. Correct. That's
Okay.
correct. Yeah.
So if you're taking more debt, and most likely if you're taking more debt, you're buying more properties, and hopefully you're buying it under trust and different structures, for asset protection thing. So how would that improve your credit score?
Well, that wouldn't show on your credit report, but it wouldn't if you're negative in, say, you've got a property in a trust entity, or you've got a business and you've got debt in there, and that goes bad, that can pull through to your personal credit score and lower your credit score. But the
Okay.
conduct of those things and the history of those things aren't on your personal score. So it's not negative or positive. It's just not on there.
Yeah.
But say you've got nothing in your personal name, no credit card, no car loan, nothing.
Yeah.
There's nothing to prove you personally can pay things. Your credit score is not going to be bad, but it might be better if you had a debt that you've got the history.
Yeah.
Yeah.
And what actually kills your credit score? If someone is watching this and they want to know, okay, I shouldn't be doing A, B, C, D, what are those things so that they
Lot-
can maintain their score or they can actually improve it?
Lots of credit applications is the one that I notice. So people go to different banks and lenders and apply for personal loans, car loans, credit cards. You see, like, you get Qantas points for a credit card. People will go apply. That shows on their credit report as an application. That brings your score down. So that's a thing. So don't apply for lots of credit unless you're going to take it. Obviously, not paying your credit on time is a big one.
Yeah.
defaults. So a lot of people have like say a Optus or a Telstra bill, usually from when they're younger, 800 bill, got the bill for the phone. Who cares? I'm not paying that. That's then a default against your name,
Yeah.
and that'll stay there for like 5 years. So you could have been 21, now you're 25, you got a good job, you got good savings, you're going to go for a home loan, but you had that bad Optus bill.
Yeah.
Creates a drama. Yeah.
For the audience who's watching this, I highly, highly recommend that you should go to Equifax or the other similar website, which gives you access to your credit score file. I think some of the websites, they give you a free report, I think once a year or twice a year. But it's very important to download your own file and go through the criteria, how they're assessing it, and what are the levels in which they put you in an excellent category, bad category, like the different sections to it. It gives you a really good understanding how you can increase your score, what things you need to look at, and most importantly, you can keep an eye out. No one is taking a loan in your name. And especially these days, there's so many identity theft is happening. People are doing dodgy stuff. So always keep an eye out and do this process at least once a year. If you don't want to pay for it, which is fine, but I think you get access to these files at least once a year. So make the use of it and keep an eye out on your credit score. Very, very important.
It's
Coming-
100% true. Yeah.
No, because I used to do that. Like, before Equifax bought this company, which I can't remember now, I used to get this report once a year, and it really made me, understand, okay, what things I should do, I shouldn't do. And
You get notifications. I don't know if you've seen it. You get notifications if there's been an application under your
Yes.
name. So there's so much,
but that doesn't happen in the free report because I had access to. I actually have to renew my paid membership, but then I took the paid membership for 2 or 3 years, and every time there's application in my name, I will get a notification. I'll get an email.
yeah.
So I thought that was very important, for me to know, like, which application is actually going through, and if anyone else is applying any loan in my name. And I would check it at least, if not monthly, definitely at least once a quarter.
Surprising how many people have never seen a credit report. Every time I help a client and give them their like loan proposal, we give them a copy of their credit report because we've got it. Why not give it to them? And people haven't never seen it before.
I
Like
know.
I would say more than 50% of people have never even looked at it.
And the way it shows you your 24 months, and then it shows the green bar if you have made all the payments. But that's what I'm asking. Like, the 1180 score was fantastic because the maximum I think I have gone is 800 or 800 something. Though it's excellent, but I always wondered how
I think
do-
like, when
how
you're
do-
owner of a business, I feel like lots of applications for credit bring it down, right? So when you run a business and you're constantly got to get finance for different things, even though it's in the business, it hits you as the director. So I feel like business people are a little bit hard done by that their credit score is a bit lower because they're always applying.
Yeah.
I see some business owners over 2 years and there's like just so many applications, but it's
I know.
part of running a business.
To be honest, it really gets me because you just trying your access, to credit and whatnot, and that it brings your score down. It's, in my opinion, it's unnecessary. But I guess bank has their own
That's
way of
how they work.
looking at
Yeah.
things. But anyway, like with the rising rates, interest rates are going up and down. As a first home buyer, what a person should be thinking about, in terms of the borrowing capacity.
hmm
Like, is it only the job which they have, the monthly or yearly earning they have, that's the criteria for their borrowing capacity, or are there other things which they can do to increase their borrowing capacity?
Yeah, different debt level obviously comes into it. So if you've got credit cards that you don't need, or you've got car loans and things like that, other debts bring it down. Some of your personal living expenses will bring it down. So everybody has a household budget, right? There's like a baseline household budget might be, I don't know, 3,000 a month for 2 people. But if you have things like private health, you have private schooling, you've got advisor fees to like your financial advisor, accountant, things like that fall outside of the base level. So sometimes having a health insurance policy that you're overpaying on that maybe you don't need it, that will hinder your borrowing power as well. So yeah.
I think there should be actually a workshop, like, what a person should be doing, especially a young person when they're entering the market. I think they should be taking a loan for car loan. They should be buying a second-hand car, something
Correct.
decent, but buy it in cash, save the money,
Correct.
keep the credit card, at a very basic level, maybe
You
$1,000,
don't need, yeah,
$2,000.
correct.
Because if you have a higher limit on your credit card, even it's 10,000, 20,000, 25,000, 15,000, the bank looks at it as if you're taking the whole money out, though you're repaying it every month, the whole amount, but the bank doesn't consider it. So I think there should be a checklist, a young person should be looking at, okay, let me do this A, B, C, keep my expenses limited, and especially in terms of borrowing, if I've taken any loan, try not to take a loan.
Don't get into things you can't get out of. Like novated leases is a big one. So a lot of like medicos, nurses, doctors,
Yeah.
they get sold, get a novated lease, get a car out of your income. Like it's really expensive. Like I've come across people paying like $1,500, $2,000 a fortnight on a novated lease. They're only earning 100 grand a year. It doesn't make sense. You should have just bought the car not out of your income like that. So there's a lot of things that can change it. If you have a credit card with a big limit that's 15,000, you could reduce it later, but you can't get out of a car loan. You can't get out of a personal loan. So there's some of those things that you got to plan for.
Definitely. I think that's a very interesting, what a young person should be thinking before buying a first home, what things they should be doing and what things they shouldn't be doing.
At the same time, it comes down to the amount they want to spend. So like maybe you can have a credit card, a car loan, a lease and all these things. And if you're buying for a reasonable price and your income's good, maybe it doesn't matter. But if you don't have a high enough income or you want to buy $1.5 million property, then those things matter. So I think it's really about planning and going, okay, I'm not buying a house now, but in the next 5 years, I want to buy a house. What do I need to earn? What should my expenses look like?
Yeah.
Pre-plan a little bit before you just rush out and grab it.
Yes, my thinking is very clear in this, Mitch. I think a young person should be entering the property market as soon as they can.
Mhm.
I would like my son, to, get his first property as soon as he turns 18. As a matter of fact, I've been coaching them since like 2 years. I've been telling them you have to buy your first property when you turn 18, and I'm going to help and support them as much as I can. And I think everyone should be doing that,
I think
because
so.
property game is a time game, and the bigger portfolio you can generate over a period of time, the easier it will be for your financially independence. And a person should be restricting their urges, like to buy a fancy car, a fancy taking personal
helps
loan
you
to go and
budget,
travel, or
yeah.
to go for a vacation or something. I think they're better off actually getting the first property, at least enter the market, and then reevaluate. You can always sell your car. You can always take the vacation next time. You can always go and stay in the hostel, or do a cheaper version of the vacation. But entering the market at the right time is very, very important.
I agree with that. And it helps you manage your finances. Even if you buy a property that's cheap, a unit in the city, and it doesn't go up in value too much, whatever, you're managing your budget, right? You've got this loan, you might start at $500,000 property, you've got to pay it, and you learn to manage it and pay it off, and you build equity by paying it off. Even if you own it for 10 years, it never goes up in value. So what? You've paid it off and you're managing yourself.
No, definitely. All right. So now let's move to seasons investor. So we're not talking about the first home buyers in that category. Let's say a person has already bought 1 or 2 properties. They have their own principal on home. They got one property or one other property as well. Now, what lending strategy should be, how it evolves and it changes if a person wants to build a property portfolio, they want to acquire, say, 5 to 10 properties. What should they be thinking? What should be their lending strategy?
Yeah, you should be thinking about your structure. So the first thing I would look at is what's your maximum borrowing power. So I would look at how many properties do you want to buy? Let's say it's 4. So how do we achieve 4, and what's your maximum borrowing power? And then the right structure to buy it in. So whether it's personal name, a company, a trust, should you use your super, all of these things take into consideration. Also, like the return from the property, is it going to be a duplex where you're going to earn higher rental income but lower growth, or is it going to be a negatively geared property where it's in an inner suburb that might cost you $1,000 a month to hold it, but it's going up in value? So you need to just work out your goal, I think, and then go from there and get the right structure for the
Okay, let's
finance.
go one by one, because I think you touch multiple areas in one go.
Yeah.
Okay, first thing you mentioned, looking at your borrowing capacity, how much you can borrow, and based on that, going how many properties you want to buy. My immediate question to you would be, let's say my borrowing capacity is, say, 1.5 million. I can borrow, up to 1.5. Should I be looking at one property? Perhaps it's not a good time to actually have this 1.5. Maybe let's talk about 2, because the median price in Brisbane has gone up to 1 million.
True.
Let's say I can borrow up to 2 million. Is it better to go and buy one property for worth $2 million, or is it better to go with the sort of middle or entry level home where we can buy it for 1 million, have two. Because a lot of time people get confused that is it better to go with the maximum borrowing for one property or have multiple properties to,
Yeah, I
that
think I think
portfolio out.
multiple properties is probably a little bit better because you're spreading your risk a little bit. Plus, the ongoing holding costs of multiple properties will be less. If you buy one property for $2 million, maybe it will rent for, I don't know, $1,200 to $1,500 a week in Brisbane. So your cost of holding that is going to be more than buying $2 million properties because you would get more rent on a return, if that makes sense. So
Like,
I'd personally go for two. That would be my choice.
fair enough.
Because I've talked to a lot of people who look at even buying $1 million property and they don't realize that the rent's not covering the loan. Like a lot of people seem to think, oh, I'll just rent the property out and we'll cover the loan. Well, it's not the case. If you're going to borrow 80, 90, 100% of the property value, it's definitely costing you money out of your pocket.
No, definitely. I think like how you can improve the value of the property, how you can make it more rent friendly, or what else you can do to increase the rent. That's a separate topic altogether. But I think fundamentally it makes sense for people, for the audience who was listening. I read this book one time and the author was talking about the median price of the suburb, and they kept on talking about it. And I didn't get it at that time. But what the author was trying to say is that if you buy the median price property in that particular suburb, it's always easy to rent out. It's always easy to sell because the premium the property is, the less the buyers are and the more time it takes. It might give you a better return as well. But I think the question is, you're looking for easy access to the property in terms of rent, selling, renting, and whatnot, or you're going to go for the high premium end. No strategy is wrong,
Mm.
but it's your own choice what you want to do.
It's true.
Now, coming back to the structures, so people who are, say, transitioning from the first home category or owner occupied category to the investor category, do you want to talk about a little bit more about trust, property trust? Like, what are the difference, in
Yeah.
buying in the
If we talk
those structures?
like purely just about your borrowing power and not about the right structure and the right property and all of that, just about borrowing power, using trusts or companies that will break off your borrowing power from your personal name to another entity. So say your maximum is $2 million and that's what you can afford on your own.
Mm.
If you borrow $2 million in a trust and that trust is positive and can cover its own debts there, that $2 million is out of your personal name. So hypothetically, you buy a couple of properties in one trust and you get that up to $2 million worth of debt there. That one's maxed out. But you personally, you don't have that $2 million. That's over in that other trust. So then you want to go and buy another property. You go open up the next trust and you put property into that trust. And hypothetically, you can carry on indefinitely with your current borrowing power. But there's more to it than just that, right? Like you got to make sure that obviously the cash flow is going to work, that
Yeah.
you can actually afford it. But if your borrowing power is 2 million, you go and buy $2 million in your personal name now,
Yeah.
you're capped out. Unless you earn more money, there's no way to
Increase
borrow
it.
more money. So you got to be again, your goal, like if you just want to have 2 investment properties, that's it, you're happy,
Mhm.
just buy it in your personal name, no problem. If you're trying to buy positively geared property and you're trying to do developments and you're trying to build this bigger thing, I think taking it out of your personal name makes it much easier to achieve.
Now, fair enough. Now, can you talk to me about debt recycling, splitting loans, and particularly about cross collateralization? Like when banks they cross collateralize your property. Like is it a good idea? Is it a bad idea? A person should be doing it or they shouldn't be doing it.
Sure. So let's say you already own your current property and you're going to buy another property, right? There's a couple of different ways that you can structure it. One easy way is through cross collateralizing the loans, which means that both of your properties are like linked together. So you would take, say, a loan of $1 million for a new property worth $1 million. Normally, you'd only be able to borrow 80% of that property value without any mortgage insurance, but your equity in your home is used as the deposit. So one way is that $1 million loan is set up and it goes against the new property plus your current property. So that's like cross collateralized. You'd have your home loan, one new loan, all done. Easy to manage. You've just got 2 loans. One's investment loan, one's home loan. Negative is that the properties are then linked together. they're at the same bank. So the alternative would be that you can do an equity release on your current home. So again, that example of $1 million purchase, you have one loan of 800 against the new property. That's totally separate. Whether it's at the same bank, another bank, it's not linked to your home. Then on your home, you would need $200,000 as a deposit. So you would do a separate equity loan to take out as a deposit. So that's tax deductible, that's all investment, and it's keeping it separate. And some people might go as far as using two different banks. You might go to Suncorp for the first loan, CommBank for the second loan. Nothing's tied. So it's an asset protection sort of approach.
No, but it does come handy because I remember one time I did the same thing. I cross-collateralized two properties and I was thinking to sell one, but then I had to release, or pay back the equity, or the deposit which I took from the first property, and I didn't enjoy the scenario. So again, depending upon what you want to do, in that particular case, like I wasn't very happy with that. So my feeling was like try to keep it as clean as possible. But again, it depends on the situation. And
It's more work for the broker because they're doing two lots of applications and it's hard. It's easier just to go, hey, client, take one loan. It's nice and easy, but it's not always the right way depending on your equity. Like if you're taking both properties to 80%,
Yeah.
there's a little bit of a downturn in the market like what happened to you. This one goes down 10%. You sell this one for a profit. The bank's going to take your profit to pay that one down because they're going to want to keep that at 80%.
so fair enough.
Yeah.
What are your views about using your own equity from the property or using your actually free cash to buy the next investment property? What are the pros and cons for each?
Well, if you've got a home loan, right, debt recycling using your own money, you could take, say, $200,000 of your own money. You could pay your home loan down because that home loan is not tax deductible. You can't claim that against anything. So it would make no sense to take your cash and put in a deposit. I would pay the home loan down
Yeah.
and then draw money back as a deposit for the new one. Still the same outcome. Say you've got
But
200,000.
wouldn't that be like a net zero effect in that case?
Yeah, but it turns the home loan to tax deductible. So for example, you owe 400 on your home loan. If you pay 200 off and you pay your home loan down by 200,
Yeah.
then we set up a new loan, which is now an investment loan for 200. That goes as the deposit. That's now tax deductible.
Got it. So
That
you get
was
the
the
tax
purpose.
benefits, basically.
Yeah.
So in terms of either you're paying the money yourself or using the equity, I think the net effect is zero, but you're getting tax advantage if you're doing the other way, where you're paying your home loan down, taking the equity out, and then putting towards as a business investment loan for the investment
Yeah.
property. So that
And even putting that aside, it makes no sense to have a home loan and not pay that off and have deposits into investment loans. Yeah.
fair enough. Um, like tell me about like what's the difference between commercial lending and residential lending? How does that differ? Is there a big difference how the banks look at it?
Yeah. Well, see, residential lending, right, for consumers is regulated. You've got like the National Credit Code, you've got best interest duty for brokers, responsible lending. So it's highly regulated and there's a lot of compliance. You've got to tick all the boxes and make sure that the client's not getting put into hardship and that you're doing the right thing by them. Like as the broker, I'm meant to give a client at least 3 options. That's the rules, right? Whereas under commercial lending, it's unregulated. So there's no such strict rules. There's no real responsible lending. There's no real checks. It doesn't matter. If I like using this lender down the road for my commercial lending, I can tell you that's the best one. I don't have to give you a choice. I can stretch your borrowing further. Maybe you can't really afford it, but there's a different mindset, a different approach to commercial lending to residential. It's more flexible in a way.
Okay. Well, today we mainly talking about residential lending, so let's stick to it.
Yeah.
Let's say a person or investor, he's looking at refinancing.
hmm
What are the red flags? What are the pros and cons, and what things they should be looking at when they're looking for refinancing?
Just the people refinancing to a better rate and putting their loan back out over 30 years makes no sense. Like I think that's a common trap. I'm on 6% and I've got a new offer to go to 5.5%, but I'm 5 years into my 30-year loan. Then I go and I refinance it back out over 30. I got a lower rate. I got a lower repayment. I'm saving all this money, but really it's costing you more money over the term of your loan. So I would suggest that if you're refinancing and you can afford your loan, just keep the loan term the same. If you've got 24 years left, refinance for 24 years to a lower rate. That will save you.
Okay, that's interesting. I never thought about that. Okay.
Also, debt consolidation is the other one. Say you've got a car loan that you want to pay off into your home loan. Again, it's easy to say, hey, I'm going to roll in that 50 grand car loan into your home loan. It's only going to cost you now I don't know, $200 a month. It was 1,000. Great, awesome savings. But now you've got that over 30 years. So if you're going to roll in like unsecured debt or car debt into your home loan, I would keep the loan term the same as well. So you might have a 5-year car loan, put it in as a 5-year repayment. So you're still paying it off in the same time,
Yeah.
but instead of paying 10%, you're paying 5%. You're saving money. There's little traps like that you don't think about.
That's interesting. Now let's talk about the market. Like, do you see any change in the lending market? What's happening, which the normal people don't see?
It is easier now compared to 12 months ago. So things got really tight probably 12 months ago, and we were sort of struggling to help people borrow their maximum and get them what they want. Now that rates have come down about 1%, it's a sort of a sweet spot.
So where are we sitting?
Like where we are now with the average owner-occupied rate around 5 to 5.5%, it's a good level for most
Are we
people.
going to see those 3%, 2.5%?
I don't
coming
think
in?
so. I don't think so. But the banks have all the buffers, right? So their pretending rates are at 8 or 9% when we're doing our loan affordability. So yeah,
Those were the good times.
it was really good. The lowest one I did, I think, was 1.89% or something like that. So it's crazy. Yeah.
Yeah.
I've had my last client come off that. Someone I helped in COVID, they chose like a 5-year fixed rate at 1.99. They just come off it a couple of weeks ago. So yeah, one of the last ones.
Where do you see the interest rate going in the next 12 months?
Oh, I really don't know. I think it's going to stay pretty much the same. Just recently, some of the banks have increased their fixed rates. So maybe 3 months ago, the banks lowered fixed rates, which is sort of an indication because they're guessing the market. And then a couple of weeks ago, those lower fixed rates have come up a bit. So I feel like things are a little bit uncertain at the
Okay.
moment.
What about the banks? Are they becoming more strict, or they're becoming more flexible, or what's
Every bank's
happening?
got their own agenda. Like, for example, like Macquarie Bank, they changed their rules. And if you've got any negative credit score whatsoever, even missed one payment on one credit card 18 months ago, they won't take you. So we had a client where we applied there when they changed those rules. We thought it was all fine because they're really good, high credit score. But yeah, 18 months ago, they missed one payment on one credit card that's closed. Macquarie said, no, we're not taking that client anymore. So that's Macquarie's agenda.
And what's happening? They're not lending to trust structures.
They're not lending to trust structures
Why is that?
anymore. I think because of the exposure to, the unlimited sort of lending and things like that. A lot of people are taking advantage of that. Like I said, it's unregulated. Even though it's a home loan, it's outside of the normal lending rules. So they're probably doing a lot of things that maybe they shouldn't have done and people couldn't really afford. So I think they must have too much exposure to that. So they want to cut that off.
Down. Okay, fair enough. We didn't talk about like self-managed super fund, but I want to briefly touch about that. So people who have money sitting in their self super or for their super, that matter, if they can take the money out and they want to go into the property investment, what things they should be looking at, like how do they invest in property through their super? Can you talk about that?
Yeah, the simplest way to say it is like a home loan. So once you've got your super fund set up, your self-managed fund, once that's all done, it's a 20% deposit, 30-year home loan. You can do interest only. It's basically like a normal home loan.
But you had to do minimum 20% or 10%, or is
Some 10% is the minimum, but the rates are higher and there's mortgage insurance and things like that. So it's basically the same rules as home loans. The difference is that the affordability is within your super fund. So your contributions that you make to super plus the rent, that's what the banks use to show that you've got the affordability for the home loan. So hypothetically, you've got 3 investment properties in your own name outside of super and you've maxed out your 2 million here, but you've got $500,000 in super in cash. You want to buy another $1 million property, you would probably be able to show affordability within the super fund because you'd have a good job paying super and the rent would cover it. That makes sense. But the actual terms of the loan is still like a home loan. And you can do commercial property and residential property in the super fund.
Fair enough. Okay. So I want to ask you some practical tips, for the viewers, like, what they can do like today. So if someone comes to you and they say, okay, Mitch, I want to increase my borrowing capacity, what should I do?
Just review your full financial position first of all, right? So like we've touched on before, credit cards, personal loans, things like that, could they go to improve your borrowing power? Have a look at your spending habits coming to it. Like I said, outside of minimum level living costs, those extra subscriptions like private health and different insurances, do you really need that, or could that go if the right property came? and just looking at your employment as well. So it's all different. Are you casual job? Have you got, are you on an ABN? Like just looking at your overall position. So
Okay.
the smartest thing is just to review everything with an advisor, I think, and have them give you some feedback and go, this is where you stand now.
Yeah.
What would you like to achieve? And then you'd be
Plan
able
it
to be
out.
shown, what
Okay.
you can change.
And when clients come to you, like, which documents they normally they get it wrong?
Just things out of date. Like I had a client today, I needed his driver's license to identify him. It expired 5 years ago. So,
5 years
yeah.
ago.
Then he didn't have the new one's a digital new one, and banks don't accept it. So there's that. Just getting the right documents as well. Like some banks are really picky. You need pay slips to be within the last 30 days. You can't give it from 60 days ago, and bank statements have to be current. Just because you got a bank statement in June's last one, the bank posted you, doesn't matter. We need it up to last month. So just getting the right documentation. But we try to smooth that out with the clients and have like a streamlined sort of process to help get all the information. It's easier than ever because everything's digital now.
Okay.
Yeah.
If you have to design a perfect client profile, which will get you easy loan approval, what does it look like?
Is there one? Yeah, like you. I mean, the perfect profile, there is no such thing. Perfect profile, you've been in your job for 2 years,
Yeah.
you've got a 20% deposit, you've got a perfect credit score. That's perfect. That's perfect profile.
Fair enough.
But yeah,
Getting the basics right.
get the things right. Like the issues are changing your job and then trying to get a home loan. Sometimes that can create a problem. Fluctuating income. So if you've got a lot of overtime and you take 2 months off, when we look at your income, it's not going to match up.
Match it.
Casual, through the Christmas period coming up, casual borrowing powers will drop. If I speak to a casual person in January, they're probably able to borrow less then than now. So apply at the right time. Yeah.
Timing is important.
Yeah, there's no real perfect client. With all the lenders we have access to, there's a lot of perfect profiles for the lenders. The lenders that take the low doc clients, the lenders that take the poor credit clients, the lenders that want the perfect clients. So yeah, we can usually fit a person to the right lender.
No, fair enough. Now, thanks a lot. So we have come to our last segment. This is my favorite section. So we're going to do some rapid fire questions.
Okay.
I'll be looking at my questions and then I'll be asking you. So I
Okay.
want you to answer whatever comes to your mind straight away.
Mm-hmm.
And let's see.
One word answer or no?
It can be a one sentence, but whatever comes to your mind.
Okay. I'll see how
All
we
right.
go.
Are you ready for it?
Yeah, let's
All
go.
right, let's go. Fixed or variable? Which one you personally would like to choose?
Right now, variable. If you're going to guess the market,
Buy now or wait 12 months?
buy now.
Interest only or principal plus interest?
It's a hard one, depending what you're doing. I like principal and interest because you're paying it off.
All right. We'll get back to it. Residential or commercial for the next 10 years?
I think residential, definitely residential.
Big four bank or second tier lender?
I like the second tier lenders. They help more people.
Okay. Worst money advice you have ever heard?
To wait and buy. Just wait to buy. No, get
Okay.
in there.
Best loan product in Australia right now?
The best loan product, I would say there's one lender that has the best rules for getting approved, where they'll give you a 40-year loan term. They'll give you a fixed rate that you can break with no exit fee and a 1% servicing buffer, which means that most banks pretend that instead of 5% rates, it's 8% because they usually add 3%.
Yeah.
This bank adds 1%. You can also live at home with your parents and buy an investment property, and your borrowing power is huge.
Wow.
So that's a one policy I really like, and it's helping people buy a lot more property at the moment.
Yeah.
Again, it's not about the cheapest rate, it's about the right structure.
So which bank is it? Can we know?
Yeah, that's through Pepper Money, that one. So they're a non-bank lender. Yeah.
Okay. Fair enough. Okay. One thing every buyer must do before applying for a loan.
Just get your documentation together. If you've got it already, it's easier for you to then apply.
Okay. What's the most surprising client story you have seen?
The most surprising one, I had one yesterday. We helped a girl buy in COVID. So first home buyer, bought a property in COVID. So 2020, we got her on the low deposit scheme, the 5% one back then. So she bought in Redbank Plains, which is out near Ipswich, for $330,000. She just sold it yesterday for $857,000. Can you believe that? And then she's rolled that into another house, and just a great story because she had hardly any deposit. Like back then, the 5% deposit, she had 15 grand, and she's just made $500,000 in like, 5 years. It's crazy. So yeah, that's highlighted my week, that one.
Alrighty, last question. If you could get only one piece of advice to your own kids before they buy a property, what would it be?
It doesn't matter where the property is. You just got to get into the market. That's my advice. My kids are never going to be able to buy right in Brisbane. They might have to move to, I don't know, who knows, Toowoomba, Bundaberg, somewhere. Get into the market. It doesn't matter where the house is. It doesn't matter about commuting for work. That's my advice. A lot of people, they don't want to live 40 minutes from the city to afford the house. They want the perfect dream house. Just get one, because it's going to go up in value, right? And you're going to get in the market. That's my advice.
All right. That was a rapid fire question. Thank you, Mitch. I want to get back to that question which I asked you, interest only or principal plus interest. You mentioned principal plus interest, but I always thought about this question for so long, and I always kept all my properties in the same structure, property plus interest. But I thought like I made a mistake, because if I have one property where I'm living, which is the principal unoccupied, if I'm paying down that property, it's fine.
Mm.
But for the other properties, like realistically, if you have multiple property portfolio, you can never pay it down because you keep on adding more and more debt. So I think the question becomes, is that the more debt you can take and the more debt you can service, in that case, wouldn't it be better to go for interest only, and then hopefully the portfolio value increases, and
Yeah.
then you
Of
are able to
course,
service
like
a
in
better
your
portfolio?
situation, like if you've got multiple investment properties, they really do need to be interest only, because it's going to be cash flow management and you can direct your money to paying your home loan off. But let's pretend you had no home loan, you paid that off. Then what are you going to do? I get a lot of clients come to me who have one investment property and they own their house outright, and their accountant said, put it on interest only. Okay, cool. Why? You've got your home, you own your house outright, you got no debts, no HEX debt, no credit cards, but you want to pay a higher interest rate and have it on interest only. Why? Are you going to are you going to buy more investment properties? No. I'm just trying to pay it off. I'm trying to save. I want the extra. Why would you pay a higher rate? Like I had a lady earlier in the week who had that same advice. Your investment property is on in principal and interest. You should refinance and put it on interest only. Well, we looked at that, and in the end, we could refinance her home loan to a lower interest rate. Principal and interest was a lower repayment than interest only. And her goal was, I just want to, try and pay it off. So I thought I could put my extra savings into my offset account. What's the point? Do you know what I mean? So
Yeah.
it's case by case. But if she had have said to me, hey, I want to buy 3 more investment properties and I want to be able to manage it the best way, and I'm going to buy one next month, I probably would have said, well, let's put this on interest only because you're preparing for
Yeah.
the next stage.
Fair.
Does that make sense?
No, it's a good thing, because I struggled with this question for so long, and again, it depends upon personal situation and circumstances. This is not financial advice. We're talking about personal experiences. But in my case, I thought it would have been better just to keep it, interest only. But again, it's dependent upon, like, as your client was saying, she had a different situation. It's
How are you going to use the money? Like you would have
Exactly.
directed all your money to paying your home loan off or for other investment purposes, and interest only is a better way. Yeah.
fair enough. Any last advice for our audience? Any last piece of advice you want to give away?
I don't know. It's the new year soon. Everyone should sit down, review their finances, make a plan for next year. Try and buy a property before, it's too late and it's too expensive. Honestly, sit down and have a look at what you're doing and make a fresh start to the year. Yeah.
Well, that's a great point you made. We are about to finish 2025. So my last piece of advice to all of you is build a right team around you. Doesn't matter if it's about property investment, it's about starting your own business, finding a right job, whatever the case may be. Find the right team around you, people who have expertise, people who know what they're doing, because you wouldn't believe how many opportunities you will miss, how many wrong decisions you will make if you don't have the right people to guide you through all those decisions and give you the right practical advice. If you're getting into property investment, don't make a plan for just today. Make a plan for 5 years. What are your goals going to be in the next 5 years? And do a reverse engineering and plan it accordingly. Then think about all the questions which comes to your mind and reach out to your team and ask all those questions. So you have clarity not only for today, but for tomorrow as well. Because property is a long-term game. It's not a short-term game. And the better prepared you are, the more clarity you have, the better decision you will make. And trust me, you don't want to make a wrong decision in the property market. every wrong decision will cost you a lot. It will give you a lot of stress. But if you make the right decision, you buy the right property at the right price, in the right location, with the right criteria, I think it will bring you financial independence sooner than you expect. Having said that, Mitch, I really appreciate you coming in and sharing all those tips, tricks, experiences, lessons with us and with the audience. And I thank you again.
Thanks, mate. It's been awesome to come and chat and talk through it all. Yeah. Thank you very much.
Thanks, mate. Take care. So this was the episode with Mitch. There were so many areas we spoke about. There were so many golden nuggets. And I hope you got some value out of it. A lot of people ask me, when is the right time to invest in the property? I always tell them, it is now. Is it day one or one day? Day one. Act on it. Get in the market. Do your research. Build your team around you. And get involved. If you have any questions, feel free to write in the comment section and I'll personally check it and I'll get back to you. In my own journey, I have bought more than 10 properties and I sold some. I had good experiences, bad experiences, learning experiences, and I'm more than happy to share it with you. But the first and foremost thing is to act, plan out your road and journey, and go for it. Also, don't forget to like, share, and subscribe. Again, it is very important to us that you subscribe to the channel so that we can keep on bringing this really exciting, valuable information to you. Thank you.